were to boil down your outlook and perspective as we head into 2019 in like one or two sentences, what would you say?
I think the market is pricing in a recession, but we don't see a recession because of continued economic growth. Earnings should still be strong, and the trade tensions with China, we believe, will be behind us.
My name is Ashley Micciche. I'm the CEO of True North Retirement Advisors, where we specialize in retirement and exit planning for business owners. I'm here with our founder and president, who also happens to be my father, Dave Wilson, and we're talking about our outlook and kind of where things stand right now, the state of the markets, the state of the economy as we close out the year and head into 2019. What's interesting is that typically in a midterm election year, historically the stock market does well at the end of the year after the election. But this year, that's not been the case. So October was brutal. The market was down almost 7% in October. November recovered a little bit. It was up 2%. And then here we are in December, and the stock market's down 7% already this month. So it's been an ugly fall. The promise of a better end of the year because of a midterm election hasn't materialized. Tell me, what is your take on where we're at right now?
I think the number one thing is that the Federal Reserve gave out indications that they were a long way from neutral, and this was back in October. And once they said they're a long way from neutral, the market interpreted that as they're going to keep increasing rates, when clearly the economy around the world was slowing. Our economy was still growing strong, but around the world and China was slowing down. So that started giving us the wild gyrations that we saw in October. Now, a few weeks after that, the Fed came back out and they said, oh, we're just below neutral. So they basically gave another signal that that we don't have to increase much. In fact, that's really the new news, is that we will probably get a 25 basis point increase on Wednesday in the Fed funds rate, and then maybe one. I don't even know if we'll get two next year.
But so you think that interest rates are, and what the Fed is doing, is the primary or one of the primary drivers for what's going on in the market right now?
Absolutely.
Okay. There might be some worsening trends, and we have a rising interest rate environment, we have trade tensions, there's a laundry list of reasons why you might be negative, but there's also a pretty long laundry list of reasons why the signs point to continued growth and why we're still positive heading into next year despite everything that's been going on recently.
Absolutely. So next year we're probably not going to grow at 3.5% like we did this year, but we're probably going to grow at 2.5%. I mean, that's stronger than we had in the previous 8 years. So, the economy's still growing. I mean, that is not a recession. Yeah. And interest rates, again, if they're not going to raise them too much, just a little bit, things are going to calm down on that front. And I think the biggest thing that really people they're a little bit too negative on is what's going to happen with China. China, you can see these little snippets of things they want to do with the trade, like in terms of the tariffs on the cars, and they're allowing some other things. In terms of us, we're going to get a deal because, again, the 2020 elections are coming up. So there's going to be some sort of compromise where both sides will declare victory, and that's what we think.
A couple of the reasons to be positive that we touched on, actually before, I know you talked about the Goldilocks scenario in a previous video and in the newsletter, but that's where we have, good, strong GDP growth, yet inflation is really low. So we still have low inflation.
Very low.
You still have unemployment that's low and steady. The trend is pretty steady there, which is a good sign.
One thing I was going to mention is that early in the year, when we had the first break in the market, when it dropped down, when we had the first 10% correction, it was fearful that the 10-year went over 3%, and then that wage pressure was kicking in. And the truth of the matter is we really never saw it happen. Everybody was waiting for it all year long. It hasn't happened.
So far, 95% of the companies in the S&P 500 have reported their earnings and revenue for the third quarter of this year. And what you notice when you look under the hood is that the vast majority, almost 80% of companies in the S&P 500 have beaten the expectation as far as their profits.
Yeah.
And about half of them have also beaten on revenue. So when you look under the hood, both at top line growth and then bottom line revenue, you still have most of these companies that not only are reporting strong earnings, strong revenue, but they're beating the expectation. And the market is, or the stock market is taking almost no notice of that as well. So
yeah, we're going to have, when the year is done, earnings are going to grow 22% this year. 22%.
yeah, and the market is not
Market's not
reflecting
giving.
it.
Now, what it means is that stocks are really cheap. I mean, we've pulled back 12% off the highs, and earnings have grown 20%. So stocks are cheap. That's another positive thing.
Yeah.
And think of your own personal situation. Are you going out? Are you buying Christmas gifts? Are you eating out? Are people hiring? We're not going to just roll over. It doesn't happen overnight. And the signs of, the signs that you look for a recession, they're just not there yet. Now, they may be there in 18 months or 2 years or something like that. We're just not seeing it for next year yet.
So the interesting thing, and I don't know what the month is, but I think early in the spring of 2019, if we get to that point, it's April or May, I think. If we get to April or May, it will be the longest economic expansion recovery in U.S. history.
Yes.
So we're talking historically, and I think a lot of the reason why, when I talk with clients, a lot of reason why I think they're nervous is because this recovery has lasted so long, and they're just waiting and waiting. When you look at averages, and we normally have a recession about every 7 years, and here we are, we're over 10 years into
Yeah.
this, and I think that more than anything is just like you're just waiting and waiting and waiting, but there's
For the shoe to drop.
yeah
And the thing is, it's not like you have a certain period and 9 years and that we're going to have a recession. It doesn't work that way. It's the business cycle. And one of the things that people they don't talk about it very much. Remember, when we came out of the Great Recession, we didn't come out like other recoveries where the market just took off. What happened is it was a slow grind. It's very, very slow.
the market and the economy. Yeah.
Market and the economy. And so the thing is, there's no reason this can't go on for a few more years. And in fact, we've had other economies around the world that have had, their economies have been growing without a recession for over 20 years. So the thing is, that doesn't mean that we can't keep growing. It's not like, somebody's going to blow the whistle and that's the end and we're in a recession.
In this environment where you have a very difficult market recently, where people are getting their statement and their accounts dropping in value, what should investors be doing right now?
Well, the first thing you shouldn't do is you shouldn't lower your allocation of stocks when the market's down 12% off the highs and you're doing it in the teeth of a correction. I mean, that just doesn't make sense. That's the worst thing you can do. In fact, last week we had a record 46.2 billion came out of mutual funds and ETFs, which was a record.
So in other words, 46 billion people got out of the market.
And it's a great contrarian indicator, because what it basically tells you, usually people are selling at the absolute wrong time. You should be buying when people are dumping stocks. So, and in fact, historically, the market actually goes up 3 months, a couple months later, the market is up very nicely after that. So again, once this passes, I think we're going to be fine. And I wouldn't be surprised, again, I don't know if the Fed comes out Wednesday with some calming words, allow the seas to calm down a little bit. That's what I fully expect. And then I think in the first quarter, again, I think everybody's going to declare victory this is my opinion, declare victory with the trade agreement. China will say, well, we didn't give in, and Trump will say, you know, we got this great deal. But I think they're going to declare victory, both sides, and then move on. And I think the markets will look quite different at that point.
There's always opportunities. In good markets, there's opportunities. In bad markets, there's opportunities. So where are the opportunities right now?
There are a couple areas. I think one of the best, when things really get ugly, you want to own the dividend-paying stocks. And we have been preaching rising dividend. I've been preaching rising dividend stocks for when I had hair. That's basically how long we've been preaching. A long time. The point is that the rising dividend stocks, they provide a cushion. When things get ugly, they provide usually a better cushion than you know, the growth stocks, which everybody, the FANGs and all these crazy companies, you know, that everybody's been invested in. Those, you know, the growth stocks, when times get tough, those dividend paying companies you want to have, because they're going to consistently pay those higher dividends over time through thick and thin. The other area are value stocks. Value stocks are companies that are probably a little bit more mature than your growth company. They typically pay a higher dividend, but they're selling at levels below where somebody would buy them significantly, maybe 25 to 50%. We think they're very attractive. They've been out of favor for the last few years, but amazingly, it's been one of the best performing asset classes over a long period of time. Value stocks. Yeah. So it's not sexy. You know, nobody really wants to talk about it, but that's an area that people should really look at.
Do you have questions about your unique situation and concerned about your own portfolio as we head into 2019? If you click below this video, there is a link to schedule a call for 15 minutes to speak with us about your situation, and we can give you some guidance as we head into next year. Did you like this video? If you did, please like, comment, subscribe. We put out new videos about once a week, and by subscribing, you'll be notified when we put out new videos. Thank you so much for watching, and we hope you have a Merry Christmas and a Happy New Year.
Talked about how cash has been the best performer.
I think
no,
there's
don't leave
too
it.
much in there.
Too much. Okay,
I think
we want to keep it not more than 4 or 5 minutes.
Yeah.